Okay, so let's start. We want to start a new topic now. And then topic we want to discuss is called retirement benefits. So let me introduce it. It's not totally a new topic because you did this topic in financial reporting. It's only that we shall develop it later. But for now, let me remind you. As an employee, in the process of your employment, there are some benefits that you are normally entitled to. So what we want to start by looking at, what are the various types of benefits that you as an employee, you are entitled to in the process of your employment. One type of benefit that you as an employee, you are entitled to in the process of your employment is called short-term benefit. Short-term benefits. Another type of benefit that you may be entitled to in the process of your employment is what we call long-term benefits. That's another type of benefit that you as an employee, you may be entitled to in the process of your employment. The other benefit you may be entitled to in the process of your employment is what we call termination benefits. Termination benefits. That's another type of benefit you as an employee, you may be entitled to. The other type of benefit that you may be entitled to in the process of your employment is what we call retirement, or what we call post-employment benefit. So let me go through each of these types of benefits and what they are to you as an employee. Now, in your organization, you may not be entitled to all of them. Some organizations don't have all of them. Some have all of them. Depends with your organization. The first one, short-term benefits. These are benefits that accrue to you as an employee. Those benefits that accrue to you for a period of less than 12 months. For a period of less than 12 months, after providing a service, that kind of a benefit is what we call a short-term benefit. Any benefit that accrues to you for a period of less than 12 months after providing a service to your employer. For example, it is obvious as an employee you are entitled to salaries and wages after every month. So that is a benefit you are entitled to, and it accrues to you for a period of less than 12 months after providing a service. Another example could be, there are some companies which by end of every year, the employees are normally paid bonus. So if your company normally pays you bonus at the end of every year, then as an employee, this is a benefit you will be entitled to, and it accrues to you for a period of less than 12 months after providing a service. Another benefit or another example could be the normal leave pay. Every year you are entitled for leave and you are still being paid for that leave. So that leave pay is another example of a short-term benefit. These are benefits that accrue to employees for a period of less than 12 months after providing a service. Good. We go to the next one. That is long-term benefits. These are benefits that accrue to you as an employee but for periods exceeding 12 months, after providing a service to your employer. Any benefit that you accrues to you for period exceeding 12 months after providing a service, then that kind of a benefit is what we call a long-term benefit. There are companies, for example, that tell their employees something like this, that if you work with us for 10 years or 20 years, the moment you clock the 20th year, we shall give you this much. Whatever that much you are entitled to, after you have attained that period that they have set for you as a minimum period, that kind of a benefit should be classified as a long-term benefit. The most obvious example is what you could call Jubilee benefits. Jubilee benefits. Okay? That's an example of a long-term benefits. There are companies whereby, another example, there are companies whereby even if you as an employee, you go for leave of more than a year, you take a leave of more than a year, and you are still being paid, that kind of a benefit that accrues to you, again, is a long-term benefit. That means if your company allows you to take what we call a sabbatical leave and you're still being paid, then that kind of a benefit is what we classify as a long-term benefit. So another example there could be sabbatical leave, where you go for leave of more than a year and you're still being paid. You're still being paid. So that's all we can say concerning the first two types of benefits. That is the short term and the long term. We go to the third one, the third type of benefit. That is termination benefit. From this term, at least you can conclude something as to what it is. What is a termination benefit? From the term, at least you should come up with something. Now listen. Termination benefit is normally two-sided. It has two sides of it. I want to explain both. One part of it is that kind of a benefit that you as an employee, you are entitled to because of the employer's decision. Because of the employer's decision to terminate your services before the normal retirement date. That benefit that you are entitled to because of the employer's decision to terminate the employee's services before the normal retirement date. That's one side of it. The second side of it is this. There could be companies whereby, and this occurs especially when they are undertaking a restructure. They want to reduce the workforce and they give the employees a package. They tell them, we want to restructure our company and we want to retire some of you. And so we are giving this package. Look at this package, and if you accept it, take it and go. So some will look at the package, they will accept it, take it and go. Some may decide no, let them continue with employment. So if you as an employee, you accept an early voluntary retirement in exchange of that kind of a benefit, then that kind of a benefit is also classified as a termination benefit. Is also classified as a termination benefit. So we are concluding by saying termination benefit, it's either that benefit that you as an employee you are entitled to, either because of the employer's decision to terminate your services before the normal retirement date, or on you as an employee accepting an early voluntary retirement in exchange of that benefit. Okay, that's what we classify as a termination benefit. We used to have what we call golden handshake. That's an example of termination benefit. Good. We now move on to the last type of benefit, and that is retirement. We also call it post-employment benefit. What kind of benefits are these? These are benefits that an employee is entitled to at the date of retirement or after the date of retirement. Any benefit that an employee is entitled to at the date of retirement or after the date of retirement, that benefit is called a retirement or a post-employment benefit. The most obvious example could be pension. Every employee is entitled to pension at the end of employment. Another example could be, there are some companies whereby they tell their employees something like this, that even after you have retired, we as a company, we shall still take care of your medical care. We shall still provide you with medical care. So if your company has what we call post-employment medical care, post-employment medical care, that is another example of a termination, of a retirement, or what we call a post-employment benefit. If your company has such an arrangement that they will still provide for you the medical care even after retirement, then that's another example of a post-employment or a retirement benefit. Okay? Before we continue, let's put down something on what we have already said. Let's put down something on what we have already said. Okay? Good. So let's have the topic. The topic is called retirement benefits. Then have another subtopic. Call it types of benefits. Types of benefits. Types of benefits. Okay. Now, maybe before we put down something, for those who are new, listen, for those who are new to my channel, please subscribe to my YouTube channel. Maybe you have not subscribed to my YouTube channel. Please subscribe to the YouTube channel. Just click that subscription button down there. You can also click the notification bell. Normally, it is for notifying you whenever we post videos into YouTube. So if you are new to my channel, that means you have not subscribed. Please subscribe to my YouTube channel by clicking that subscription button down there. Click that subscription button down there. You can also click the notification bell. Okay, so let's continue now. Let's continue. Now we can put down the notes. Okay. So we are saying the subtopic is types of benefit. Number one, say this. Number one, short-term benefits. And you say this, put a dash. These are benefits that accrue to employees. These are benefits that accrue to employees. These are benefits that accrue to employees for period of less than 12 months. These are benefits that accrue to employees for period of less than 12 months after providing a service. These are benefits that accrue to employees for periods of less than 12 months after providing a service to the employer. after providing a service to the employer. These are benefits that accrue to employees for a period of less than 12 months after providing a service to the employer. E.g., salaries and wages, e.g. salaries and wages, leave pay, bonus, etc. Leave pay, bonus, etc. Number two, long-term benefits. Long-term benefits. These are benefits that accrue to employees. For periods exceeding 12 months. These are benefits that accrue to employees for period exceeding 12 months after providing a service. These are benefits that accrue to employees for periods exceeding 12 months after providing a service to the employer. These are benefits that accrue to employees for period exceeding 12 months after providing a service to the employer. After providing a service to the employer. E.g., jubilee benefits, and sabbatical leave. E.g. jubilee benefits and sabbatical leave. Okay. Number three, termination benefits. Termination benefits. These are benefits that accrue to employees. Either on the employer's decision, to terminate, the employee's contract, before the normal retirement date. Terminate the employee's contract before the normal retirement date. Or on the employees with an apostrophe, or on the employee's decision, to accept, an early voluntary, retirement in exchange of the benefits, or on an employee's decision to accept an early voluntary retirement in exchange of the benefits. Good. Number four, Number 4, retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Then you say this, these are benefits that accrue to employees. These are benefits that accrue to employees at or after the normal retirement date. These are benefits that accrue to employees at or after the normal retirement date. At or after the normal retirement date. E.g., pension and post-employment medical care. E.g., pension and post-employment medical care. And post-employment medical care. Good. That is it about those types of benefits that you as an employee, you are entitled to in the process of your employment. Now, in this topic, we want to look at one specific one, and that's what we are calling retirement benefit. Don't forget, the topic is retirement benefit. So in principle, we are looking at the mechanisms of how retirement benefits operate, how to calculate it, that's what we shall talk about, and so on. Okay? So let me introduce that last one, retirement benefits. First, listen, before we talk about how much you will take home, you as an employee, at the date of retirement, we also need to know, how does a pension scheme or a retirement scheme operate? How does that scheme operate? So let me remind you, because I've told you, this is not a new area to you. It is something you did in financial reporting, so I'm reminding you. But before we look at how to compute the retirement benefits amount and blah, 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 the charges, we need to talk about how does a pension scheme, we need to remind ourselves, how does a pension scheme operate? Now, in a pension scheme, normally the employer would normally send a regular contribution. The employer, and in some companies, the employees also. You contribute something, the employer contributes something every month, and you send it to a funding agent. So in a pension scheme, we are saying regular contributions are made to a fund. Those contributions are normally invested by the funding agent, whoever the funding agent is. The funding agent could be a trustee like NSSF, or the funding agent could be an insurance company. There are some insurance companies that manages pension schemes for companies. Okay? Once those contributions are invested by the agent, it is that funding agent who will normally pay the benefits to the employees when they retire. So in general, that's how a pension scheme operates. That contributions are made. Regular contributions are made either by both the employer and the employee. They make regular contributions to the fund. Those contributions are invested by the funding agent, and it is the funding agent who normally pays the benefits to the employees when they retire. Good. Now, as an employer, there are two ways in which you can go into this kind of arrangement. There are two ways in which you can go into this kind of a pension scheme. So we normally define or talk about what we call types of pension plans. Types of pension plans. Again, this is not new. These are things you know and you have already done. In other words, as an employer, how can you go into a pension scheme on behalf of your employees? There are two methods that you can use to go into this kind of arrangement where you'll be making regular contributions. They are invested. Then the funding agent pays the benefits to the employees when they retire. There are two ways in which a company can go into this arrangement. One way is what we call the defined contribution plan. To use what we call a defined contribution plan. A defined contribution plan. The second one is what we call a defined benefit plan. A defined benefit plan. Now, in financial reporting, these two terms, you remember, you used to be required at times to distinguish them. Even at this level, you are normally required once in a while to distinguish between what is a defined benefit plan and what is a defined contribution plan. Let me start with the first one. In a defined contribution plan, the contributions that you as an employer you make into the fund, those contributions are normally defined. That means as an employer, you know your obligation in advance. How much you will be contributing to the fund, the amount is known in advance. For example, you may decide that you will be contributing 2,000 shillings every month on behalf of your employees. So in a defined contribution plan, the contributions are defined. They are known in advance. Okay? Now, but listen, still under the same, how much the employees will take home as their benefits 10 years, 20 years from now, that amount is not known in advance. In other words, in a defined contribution plan, the benefits are not defined. The benefits are not defined. They are not known in advance. It may happen the employees will take home more, or he may take home less at the date of retirement. So the question is, what will influence the amount that the employees will receive at the date of retirement? Now listen, we have already said, in a defined contribution plan or in a pension scheme, I told you, contributions are sent to the fund. I told you those contributions are invested. So, obvious therefore, if the investments in the fund perform well, then it means that the fund will be able to afford to pay higher benefits to the employees when they retire. If the investments perform well. Otherwise, if the investments perform poorly, then the fund will pay less benefits to the employees when they retire. That's why we are saying the benefits are not defined. The amount of the benefit will depend on the performance of the investments in the fund. If the investments perform well, then the fund will pay higher benefits. If the investments perform poorly, then the fund will pay less benefits. Good. So that's all we can say concerning the first plan that you as an employer you can use to go into a pension scheme. You can decide to use the defined contribution plan, whereby you know your contributions in advance, they are defined. But the benefits that the employees will take home at the date of retirement, those benefits are not defined. We have said the amount of the benefit will depend on the performance of the investments in the fund. If the investments perform well, the benefits will be more. The investments perform poorly, the benefits will be less. Good. The second one is what we are calling defined benefit plan. Now, in this second one, the benefits now that the employees will take home at the date of retirement, those benefits are defined. That means the employees themselves, they know 10 years, 20 years from now, how much they will take home at the date of retirement. Could be, for example, your company is one that has promised them 1 million shillings at the date of retirement. So they know they'll go home with 1 million 5 years, 10 years from now. But, listen, in a defined benefit plan, the contributions now to the fund, those contributions are not defined. The contributions are not defined. That means we don't know the amount in advance. So the question is, how much do I as an employer make as contributions? How much will I make as contributions to this fund in order for the fund to create a fund of 1 million shillings? How much do I contribute to the fund so that this fund will be able to afford to pay the benefit of 1 million 10 years from now? Listen to this. It is at this point in time that you as a company, you will require the services of the actuaries, or what you can call actuaries. You will call them and you will ask them to calculate for you how much is it that you as an employer, you should contribute in order to create a fund of 1 million 10 years from now. So it means, listen, you as an employer and the actuaries, you will sit down and come up with the assumption of the scheme that you want to develop. One of the assumptions you will make is this. We have said, remember, those contributions are invested by the funding agent. These contributions, we have said, they are invested by the funding agent. So one of the assumptions you will have to make is to ask yourself, what are we expecting to be the market rate of return? What are we expecting to be the market rate of return? Could be that you as a company, you project that the market will be earning at 10%. So that's one of the assumptions you come up with. Other assumptions is, or other assumptions in the scheme will include, when are the employees retiring? What is the employer's turnover rate? When are they? What is the current salary? And so on. All those assumptions. How many workers do you have? When are we expecting them to retire? What is their current salary? What's their projections in terms of salaries? And so on. Those are some of the assumptions that you'll have to come up with. Now, so I'm using this one as an example that they are projecting a return of 10%. The actuaries will calculate and see, for example, they might see that if you as an employer, you make a contribution of 2,000 every year. That's an example. Earning a return of 10%, they realize that if the 2,000 can earn 10% for the next 10 years, That will create a fund of 1 million shillings 10 years from now. So they would calculate an amount that is expected to earn enough return to meet this future obligation of paying the benefit. They calculate an amount that is expected to earn enough return to meet this obligation of paying the benefits. Okay, good. Now the question comes. They told you as an employer, please start contributing 2,000 for every employee, whatever it is. But what happens if after 2 years, our fund is no longer earning 10% as per the projection, but your fund is earning now 8%? That could be the market rate of return 2 years later. So what does it mean? It means that if you as an employer, you continue contributing 2,000, now earning 8% instead of 10% as per the projections, will this fund be able to pay the 1 million? No. If we continue earning 8%, then our fund will be insufficient, or will have insufficient funds to pay for the benefits. Remember, you can't change the benefits. The benefits are defined, they are known in advance. So if we earn 8% instead of 10, your fund will be said to have what we call a deficit. Your fund will have a deficit. What if you as an employer, you are told to contribute 2,000, we expect you to earn 10%. Suppose after 2 years, now you realize again, your fund is no longer earning 10% as per the projections, but your fund is earning 12%. What happens? It means if I continue contributing 2,000, now earning 12% instead of 10, then this fund will be larger than expected. Our fund will be larger than expected, meaning our fund will have what we call a surplus. So the question is this: how do we correct all these scenarios? When your fund has a surplus, what do you do? When your fund has a deficit, what do you do? Remember, I've told you this is not new to you. You must have done this before. So, and I hope you can still remember what you used to say when a fund has a deficit. In other words, how do you correct that scenario when a fund has a deficit? When a fund has a surplus, how do you correct that scenario? Today, I've not asked you any question. Maybe I could start by asking you the first one now. Remind me how you used to correct a scenario where a fund had a deficit. Remember, I've told you, we cannot change the benefits. In a defined benefit plan, the obligation 10 years from now remains fixed, remains defined. That is the 1 million. But we are contributing 2,000. Now we are earning 8% instead of 10. If we continue contributing 2,000, then our fund will not be able to pay the benefits. How do you correct that scenario? Somebody to chat down there and give me the way you remember you used to do in order to correct a scenario where your fund has a deficit. How are you correcting it? Chat 1 or 2 words, I'll be able to know. You chat down there and tell me, how are you correcting a deficit circumstance? Somebody to chat down there, tell me, how are you correcting? Because I've told you this is not new to you. This is a topic you must have done in financial reporting. Yes. I'm waiting. Please chat down there There is a live chat. I will see it on my screen. You chat. Tell me how you are correcting a scenario where a fund has a deficit. What will be required of the employer? Because if we continue contributing 2,000, we shall not be able to pay the 1 million. How then do we correct that? Somebody to chat. Chat down there and tell me, what were you doing? What do you remember? To correct a deficit. What do you do? Oh, seems most people have forgotten. Somebody to chat. Deficit are good. Thank you. Who is that? Moses. Thank you, Moses. So we are saying that to correct that deficit circumstance, the employer will be required to make what we call additional contributions. The employer will be required to bring in additional contributions so as to make up for the expected shortfall. The employer will be required to make additional contributions so as to make up for the expected shortfall. Good. Tell me also, what if we continue contributing 2,000? Now we are no longer earning 10% as per the projections, but now we are earning 12%. We have said our fund will be larger than expected. That means our fund will have a surplus. What do you do? As an employer, what will be required of you? Continue. Maybe Charlo. Moses, you can remind us a second scenario. What were you doing? Or what were you saying when your fund has a surplus? What do you do to correct that position? Yes. What do you do to correct that position? Yes, somebody? Somebody else can also help Moses. Yes. Wow. When a fund had a surplus, to correct that position, remember the benefits cannot change. But if we continue contributing 2,000, earning 12%, then the fund will have more than enough. We don't want the fund to have more than enough. We just want the fund to have sufficient funds to pay for the benefit. So what do we do? Yes. Decrease the contribution. Okay, it's almost the same. Okay, fine. So let me explain. So when a fund has a surplus, the employer will be required to stop contributing. The employer will be told to stop contributing for a short while. Stop contributing for a short while so that we utilize the excess that was developed. Then later you can continue to contribute. Listen, that process of stopping to contribute for a short while, we say the employer will be required to take what we call a contribution holiday. The employer will be required to take what we call a contribution holiday. So where your fund has a surplus, the employer will be allowed to take a contribution holiday. That means to stop contributing a short while. Good. So maybe before we continue, we could put down something now on what we have already said. Let's put down something now on what we have already said so far. So have a subheading. We started by looking at how a pension scheme operates. Maybe we could put down that. We could not discuss how pension schemes operate without. We could not discuss the types of pension schemes or pension plans without knowing first how a pension scheme operates. So maybe you can put down a subheading, how pension schemes, as a subheading, how pension schemes operate. How pension schemes operate, as a subheading. How pension schemes operate. Then you say this: the employer, put down this, the employer and possibly the employee, the employer and possibly the employee make a regular contribution, to the fund. Say the employer and possibly the employee make a regular contribution to the fund. Stop, continue. These contributions are invested. These contributions are invested by the funding agent. These contributions are invested by the funding agent. These contributions are invested by the funding agent. Comma. These contributions are invested by the funding agent, comma, who later pays the benefits. Who later pays the benefits to the employees when they retire. Later pays the benefits to the employees when they retire. Later pays the benefits to the employees when they retire. Full stop. Another paragraph. The funding agent may be a trustee. Funding agent may be a trustee. E.g. NSSF. Funding agent may be a trustee, e.g. NSSF, or an insurance company. Or an insurance company. Or an insurance company. Good. That's how a pension scheme operates. The employer and possibly the employee, they make a regular contributions to the fund. Those contributions are invested by the funding agent, who later pays the benefits to the employees when they retire. That's okay. Have another subheading now. Types of pension plans. Subheading, types of pension plans. Types of pension plans. Types of pension plans. Number one, defined contribution plan. One, defined contribution plan. Defined contribution plan. Then you say this. Defined contribution plan. Then you say this below that. In this plan, the contributions to the fund, the contributions to the fund are defined. The contributions to the fund are defined, i.e., they are known in advance. I.e., they are known in advance. They are known in advance, comma, but the benefits that the employees will receive the benefits the employees will receive, but the benefits that the employees will receive at the date of retirement, the benefits that the employees will receive at the date of retirement are not defined. Are not defined. Are not defined. We'll stop the paragraph. The amount of the benefits, will depend. The amount of the benefits will depend on the performance of the investment in the fund. The amount of the benefits will depend on the performance of the investments in the fund. In the fund. The amount of the benefits will depend on the performance of the investments in the fund. Stop. Continue. If the investments perform well, then the fund will be able to pay higher benefits to the employees. If the investments perform well, then the fund will be able to pay higher benefits to the employees. Stop. Stop. If the investments perform poorly, then the fund will pay less benefits. The fund will pay less benefits to the employees when they retire. If the investments perform poorly, then the fund will pay less benefits to the employees when they retire. Good. That's all for the first one. We shall come back to it later. But now, when we shall be doing computations, that we shall come back to it later. But for now, that's what it is. And how we have said the contributions are defined, the benefits are not defined. The amount of the benefits will depend on the performance of the investments in the fund. The investments perform well, the fund will pay higher benefits to the employees. The investments perform poorly, then the fund will pay less benefits to the employees. Good. Number two, defined benefit plan. Defined benefit plan. Number two, defined benefit plan. Defined benefit plan. Defined benefit plan. Can you say this? In this plan, the benefits that the employees will take home, at the date of retirement, this plan, the benefits that the employees will take home at the date of retirement are defined, i.e., they are known in advance. They are known in advance. They are known in advance, comma, but the contributions to the fund, are not defined. But the contributions to the fund are not defined. Stop, continue. The contributions are set. The contributions are set at such an amount. The contributions are set at such an amount that is expected. The contributions are set at such an amount that is expected to earn that is expected to earn enough return. The contributions are set at such an amount that is expected to earn enough return to meet the obligation. Contributions are set at such an amount that is expected to earn enough return to meet the obligation of paying the benefits. The contributions are set at such an amount that is expected to earn enough return to meet the obligation of paying the benefits. Another paragraph. If it becomes apparent that the investments in the fund, are insufficient to pay for the benefits, if it becomes apparent that the investments in the fund are insufficient to pay for the benefits, we are saying investments in the fund. Don't forget, I told you contributions are invested. So use contributions to pay, you use the investments to pay the benefits. Okay? So if the investments in the fund are insufficient to pay for the benefits, then the employer, say it, if it becomes apparent, that's what we have said, it becomes apparent that the investments in the fund are insufficient to pay for the benefits, then the employer will be required to make additional contributions. The employer will be required to make additional contributions into the fund. The employer will be required to make additional contributions into the fund so as to make up for the expected shortfall. Another paragraph. If it becomes, put it this way. If the funds with an apostrophe, if the fund's assets appear to be larger, if the funds with an apostrophe, if the fund's assets appear to be larger than expected, if the fund's assets appear to be larger than expected to pay for the benefits, if the fund's assets appear to be larger than expected to pay for the benefits, the employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday, i.e., the employer may be allowed to take a contribution holiday, i.e., stop contributing for a short while, i.e., stop contributing a short while. Stop contributing for a short while. Good. I hope so far so good. If you have any question, you can chat. I will see it on my screen. But I hope so far so good. Hope you are following what we have said. Now, before we go to the computations part of it, before we go to the computations part of the topic, I want to mention some other terms that we shall need, or we need to define some other terms that we shall need in our calculation part of the topic. And also sometimes the examiner still tells you to define them. So let me talk about a few more terms that are normally used in this topic. So we want to talk about what we call other terms used in pension. So let me talk about them first, then we shall put them down. So one of the terms you need to know, and which you may be told to talk about, is what we call current, we also call it present service cost. Okay. Another term you may be required to know is what we call past stroke prior service cost. Another term you may be required to know is what we call actual gain or loss. What's an actual gain or loss? Another term you may be required to know is what we call experience surplus, or what we call deficit. What's an experience surplus or deficit? That term you may be required to know is what we call experience adjustments. Experience adjustments. So let me go through these terms. The first one, what is a current service cost? Now, let me assume that you as an employer, you started your company several years ago. For all those years, you did not have a pension scheme. But beginning this year, you decided as an employer, you're going to have a pension scheme on behalf, or you're going to operate a pension scheme on behalf of your employees. So let me assume our current year is 2020. I'm assuming. So you decided after every month, the employees having given me a service, I'll be sending this much to the funding agent. Every month after they give me a service, I'll be sending this much to the funding agent. So you are making those contributions for services that were rendered to you after the scheme was initiated. So you will account for those contributions in the books of 2020. You will account for them as a current service cost. These are contributions made for services rendered after the scheme has been initiated. Okay? What about past service cost? To give an example of a past service cost, listen, suppose you as an employer, you decided that this year 2020, I still want to make contributions for services that the employees gave me in the year 2019 when I did not have a scheme. I also want to make contributions in the year 2020 for services the employees gave me in the year 2018. Those times I did not have a pension scheme, but the employees gave me a service. I want to make a contribution, that kind of a service. This year, how will I account for them? I will account for those kind of contributions as a past service cost. So in other words, we are saying these are contributions made for services rendered before the scheme was initiated. Contributions made, services rendered before the scheme was initiated. That kind of a contribution, we account for it as a past service cost. So present or current service cost are contributions made, service rendered before the scheme was initiated. Past service cost, most cases, is for that kind of a contributions made for service rendered before the scheme was initiated. Good. Actual gain, number 3, actual gain or loss. Now, before I talk about what's an actual gain or what's an actual loss, I want to take you back to what we said about how a pension scheme operates, and especially where we had a defined benefit plan. You remember we said in a defined benefit plan, the contributions are not defined. That's what we said. In a defined contribution plan, the contributions to the fund are not defined. But I told you the benefits that the employees will take home at the date of retirement, those benefits are defined. Now, I also told you, before I talk about what's an actual gain or loss, I told you, suppose we as a company, we want our employees to take home 1 million 10 years from now. What contributions should I make as an employer in order? What amount of contribution should I make to the fund in order to create this fund of shillings 1 million? I told you it's at this point in time that you will require the services of the actuaries. I told you, you will sit down and come up with the assumptions of the scheme. One of the assumptions you will come up with is, what are we projecting to be the market rate of return? I told you, suppose we project a return of 10%. We agreed that the actuaries will calculate and say that if, for example, we contribute 2,000 shillings every month, earning a return of 10%, that will create a fund of 1 million. Then we went further and said, what if after 2 years, your fund is no longer earning 10% as per the projections, but your fund is earning 8%? What will happen? Said your fund will have what? A deficit. Your fund will not be able to pay the benefits. So I told you, to correct that scenario, what do? The employer will be told to make additional contributions. Then I told you, what if your fund is no longer earning 10% as per the projections, but it's now earning 12%? I said, in case that is the scenario, then if you continue contributing 2,000, earning 12%, this fund will be larger than expected. I told you, your fund will have what we call a surplus. I also told you, what do you do to correct that? When your fund has a surplus, said the employer will be allowed to take a contribution holiday. The employer will be told to take a contribution holiday. Now listen. What is an actual gain? What is an actual loss? Now, we projected that our fund will be earning 10%. If your fund is now earning 12% instead of 10%, your investments in the fund are earning a return of 12% instead of 10%, then we say that your fund will have what we are calling an actual gain. If your earnings in the fund, they exceed, if the actual earnings in the fund exceed the projected earnings, We say the fund has an actuarial gain. And if you have actual earnings, if the actual earnings are less than the projected earnings, we projected 10%, but our fund is earning 8%. What will happen? Our fund will have what we call an actuarial loss. So we normally say actuarial gains occur where the actual earnings in the fund exceed the projected earnings. An actuarial loss occurs where the actual earnings in the fund are less than the projected earnings. Are you there? Good. So we are through with the term number 3. What's an actuarial gain? What's an actuarial loss? Now, I've told you a gain occurs where the earnings in the fund exceed the projected earnings. That gives rise to an actuarial gain. An actuarial loss, we have said, occurs where the actual earnings in the fund are less than the projected earnings. That will give rise to an actuarial loss. Good. Now, let me go to number 4 now, and that is experience surplus or deficits. Now, I take you back again to the same kind of a scheme, which we are calling a defined benefit plan. In this plan, I've told you the benefits that the employees will take home at the date of retirement. Those benefits, we said, are defined. They are known in advance. But the contributions I told you, they are not defined. They are not defined. Now, listen. If you as a company, you want to know this fund that we are operating, is it able to meet that obligation? You want to find out, is our fund able to meet that obligation of paying the benefit of 1 million? Are we able to meet this obligation as a fund? For you to find out whether your fund is able to meet that obligation or not, then you can compare the assets of the fund with the liabilities of the fund. The assets are obviously in form of investments. Don't forget, I told you every time you make contributions to the fund, those contributions are invested. So the assets of this fund are normally in form of investments. The liabilities of the fund are those benefits that the employees will pay 10 years from now, 5 years from now, whichever the period. So are we able to pay these benefits of 1 million? We compare that 1 million with the assets of the fund. If, listen to this, if the assets of the fund exceed the liabilities of the fund, then we say your fund has an experience surplus. It has an experience surplus. If the assets of the fund exceed the liabilities of the fund, then we say your fund has a surplus. Call it an experience surplus. Otherwise, if the assets of the fund are less than the liabilities of the fund, then we say your fund has an experience deficit. It has an experience deficit. Okay? Now, so it means therefore, I am through with the 4th term. Now listen. I've said, what's an experience surplus? what's an experience deficit? An experience surplus, an experience deficit, we are comparing what? We are comparing the assets of the fund with the liabilities of the fund. We have said the assets of the fund are in form of investments. Liabilities of the fund are the benefits or the obligations you will pay 10 years later. Are we able to pay that obligation? You can compare the assets of the fund with the liabilities of the fund. I've said an experience surplus occurs where the fund's assets exceed the fund's liabilities. When the fund's assets exceed the fund's liabilities, that gives rise to what we call an experience surplus. An experience deficit occurs where the fund's assets are less than the fund's liabilities. That's what we call an experience deficit. Now, before I go to the last term, which is experience adjustments, I want to hope that you have noticed that actuarial gains and experience surplus or deficit, these two, either actuarial gain or experience surplus or deficit or loss, they come up because of the same experience. In the sense that I told you, we agreed with the actuaries we shall be contributing 2,000. We projected that we shall be earning 10%. We started earning 8%. What will happen? That we said, if we continue contributing 2,000, earning 8 instead of 10, the assets in the fund will not be sufficient. They will be insufficient. So we are saying that will give rise to a deficit. It's so called saying we expected 10%, now we are earning 8%. It will make our fund to have an actual loss. At the same time, it will make our fund to have an experience deficit. We projected 10%. We agreed with the actuaries we shall be contributing 2,000. But now we are earning 12%. If we continue contributing 2,000, now earning 12%, what happens to the fund? That fund will be larger than expected. So it will have more assets than required. That means it will have a surplus. So your fund will have a surplus. At the same time, the fund will also be said to have an actual gain. So what's the difference between these two terms, actual gain and experience surplus? Listen, when you're taught to distinguish these two terms, listen, when you're defining what's an actual gain or loss, we look at the fund, listen, we look at the fund from the point of view of the earnings, When you look at the fund from the point of view of its earnings, then that will give rise to what we are calling an actual gain or loss. We said actual gains occur where the actual earnings in the fund exceed the projected earnings. Said actual loss occurs where the actual earnings in the fund are less than the projected earnings. Okay, good. Then from there, when you are taught to define what's an experience surplus, now we don't look at it from the point of view of the earnings. We look at it from the point of view of what? Assets and liabilities. Get the point there? So when you are discussing what's an experience surplus or deficit, we look at it from the point of view of the assets and liabilities. where the fund's assets appear to be larger than expected, that makes the fund to have a surplus. When your fund assets now are less than the fund's liabilities, then that will give rise to what we call an experience deficit. So experience surplus and deficit, talk about it from the point of view of the assets and liabilities. I hope you're following. Okay. Talk about it from the point of view of assets and liabilities for experience surplus and deficit. When you're talking about what's an actual gain or loss, talk about from the point of view of the actual earnings in the fund compared to the projected earnings. In other words, you talk about it from the point of view of the earnings. Good. We go to the last term, and that is what we are calling experience adjustments. What are these? Listen. Already you know them because these are adjustments. Experience adjustments are adjustments that are made to the fund. Experience adjustments are adjustments that are made to a fund. Those are the adjustments made to a fund to correct either what we are calling an experience surplus or to correct an experience deficit. Of course, we have already mentioned the corrections of the fund. Where your fund has an experience surplus, what did we say? Where your fund has a more than enough, we said the employer will be told to do what? To take a contribution holiday. That means to stop contributing for a short while. Good. Then I also said, what happens when your fund has a deficit? Remember, we couldn't change the benefits. What will the employer be required to do? To bring in additional contributions to the fund so as to make up for the expected shortfall. That is the adjustment for the fund which has a deficit. The employer will be required to make additional contribution. When you are told to define what are experience adjustments, we are saying these are adjustments that are made to a fund either to correct an experience surplus or to correct an experience deficit. Okay? To correct a surplus, take a holiday. To correct a deficit, bring in additional contributions. Good. Now, so that's all about those terms. Today I wanted to stop there. Next time, I'm going to give the notes on those terms. Then from there, now we start doing the computation part of the topic now. So allow me to stop there for today. Then next time we give the notes and then I now develop the topic by looking at the computation part of the topic. Okay? That is it for today. Otherwise, we can stop there for now. I've told you, for those who are new to the class, and they have not subscribed to my YouTube channel, please subscribe to the channel. Just click that subscription button so that whenever we post videos, you will be notified. Kindly share the course outline. You can download the CASNEP syllabus from the internet. They are available. That's not a big problem. Okay? No problem. Otherwise, subscribe to my YouTube channel if you have not subscribed. Hit that subscription button down there and the notification bell. Otherwise, see you next time. Unless there is a question, good night for now. Bye for now. Thanks. Okay. Yes, that is who. Sewe. Thank you. Have a good night. See you next time. Bye for now. Good night. Bye. Good night. Yes, listen, somebody's asking the pre-recorded. Just go back to the group. Just go back to the group. The link does not expire. The link does not expire. Just click the link and it will open any other time. Listen, everybody now. Listen, everybody now. Listen, everybody now. We are saying, somebody's asking, he joined late. If you want to watch the video again, even if you watched it from the beginning, just go back to the group. Click on the link again, even after class or 2 days after class. Just go back to the group, click the link again, and you will be able to watch the video again as many times as you want. Okay, Esther? Esther, are you okay now? We are saying, anytime you miss a class, listen, anytime you miss a class, just go back to the group. Click on the link of the class that you missed, because the links will be there. The class will open, the video will open, and you'll be able to watch the video at your own free time, at your own pace. Okay? So whenever you miss a class, don't panic. You can still watch the video of the class that you missed. The other important point we have said, listen, the other important point we have said is this, that whenever you are watching a live class, a live video, I've also put that information in the group. What if you are disconnected because of your Wi-Fi strength? I've put that information in the group. What do you do? It's already there. Okay. Good night, everyone. See you next time. Bye. Thank you, Helen. Helen says he has understood. Thank you.